All right, well, I'm just gonna awkwardly stand here, and I'm gonna give you guys the podium, so we're gonna have to do this trading places thing. So this is gonna run in 3 steps. The first step is opening arguments. The second step is a frothy, wild debate between both sides. And the third step is closing arguments. Everybody's prepared with our opening arguments?
Yes.
Sure.
Do we do a poll first?
Yeah, we're gonna do the poll first. So, how is this going to be measured for success? Who is going to win? Well, the winners of this debate are not going to win based on who is right, but who has influenced the most minds. So, if you don't believe that 2022, if you believe that 2022 is the biggest buy year this economic cycle, you probably agree with the vast majority of this audience, which means that this team debating for the motion has a much more difficult time. There's going to be a lot less folks to influence the minds. If you're against the motion from the get-go and they influence more minds, they could win. So it's not about who is right, it's about who influences the most minds. So, we good? Okay. You can open up your Whova app, you can go to the agenda, you can find the intellectual debate at the end of the day on Friday, and there is a poll that is live. Will 2022, do you have a maybe, or an unknown, or a neutral in there? You do? Yeah, okay, hold on one second. Let's throw a neutral in there. All right, cool. All right, so you can open up the poll in the agenda. Will 2022 be the biggest buy year this economic cycle? Yes, no, undecided. Oh, I don't know, I could be influenced either way. Fill it out now. Whether or not for or against the motion wins is based off of your votes now, and again, a second time at the end of the poll. The winners will be decided based on the delta. So I'm gonna give you guys 60 more seconds, and during that time, I'm gonna turn around here, and I'm gonna watch you guys stare at each other. Who's gonna win the debate? This is the 6th year of the intellectual debate, and there are 3 folks who have done this before. Kathy, this is your 2nd debate?
Yes.
What's your track record?
Well, it will be 2-2.
Oh, it will be 2 out of 2. Okay. And John and Hunter, you guys were on opposing sides last year. Who was the winner last year?
They won last year, although the numbers are actually coming out that I was actually right.
Oh, shots fired. Well, we got one previous winner on this side, one previous winner on this side. This should be fun. All right, we're going to close the poll in 5, 4, 3, 2, 1. Excellent. Okay, 4 is going first in their opening remarks. Do you guys have who's picked out to go first? Okay, so we're going to go Hunter. Who's going to go first here? John, Bob, Kathy, for closing. We're going to go in the reverse order. Hunter, 2 minutes on the clock.
All right. How's everyone doing? So, about 3 weeks ago, I told my wife, they asked me to do a debate, but the good news is my opponents are not well researched, not well known, and are relatively incompetent. Unfortunately, they switched out those opponents, and they were replaced by the VP over at Marcus & Millichap's, which spent about $5 million a year on data and analytics, and the host of the most well-received podcast in real estate. So here we are, nonetheless. Right before I came up on stage, Ben said, it doesn't really matter who's right in this. We're just trying to figure out the debate. It's fun. I couldn't disagree more, right? Raise your hand right now if you're waiting for prices to correct. Raise your hand. I know a lot of you are. So I'm here to make the case that it's not going to happen. In fact, it is currently happening. This is the massive buying opportunity of the economic cycle, and likely many economic cycles into the future. The Fed has created a situation where anytime there's a sneeze, a whiff of a recession, or even concerns around such, they're going to smash the multi-trillion-dollar button over and over again, both in terms of printing money and in terms of reducing interest rates. And what that's created is 3 pieces of things that are insurmountable. Number 1, increasing inflation that drastically favors real estate investors, both in terms of rental increases and in terms of equity valuations. Number 2, the health of the consumer. We're going to talk about some data today that is absolutely unbelievable. We are talking about all-time highs in terms of consumer net worth, in terms of household income, in terms of consumer sentiment, in terms of unemployment, on and on. These are massive foundational, fundamental things that don't just ebb and flow quickly, but are founded on things like job growth, population growth, et cetera, et cetera. And lastly, number 3, and this is really the most important, the incredible supply and demand imbalance in real estate that all of us are here to benefit from. This is insurmountable. There is no way the type of data that we're going to talk about today is so large and so insurmountable in the markets that we're all focused on. Phoenix, Austin, Sunbelt markets in Florida, the supply and demand imbalance. The National Association of Realtors recently put out something, and many other studies similar, that show that we're undersupplied by about 5 million units. There's a massive affordability crisis taking place in the United States right now. And here's the thing. If at any time our opponents have a solution for the massive affordability problem in the United States, I will gladly cede the rest of my time to them. There's just no way that prices are not continuing to go up and cap rates are going to smash down. I'm not trying to move the goalpost of the motion, but I want to move the Overton window. All the conversations are when cap rates are going to go back to blank need to be stopped. We need to look forward to what's taking place in Europe, what's taking place in Japan. That's the future of US cap rates. That's the future of what real rates are going to look like in the United States. So there we go. Ready to have some fun?
Woo. John Chang, you've got 2 minutes on the clock until the timer hits 44.
That was an outstanding way to start. 2021 was a fantastic year in brokerage, right? The transaction count, we measured about 84,000 commercial real estate transactions over $1 million last year. That is a record, never hit before. It is 8% higher than what was achieved in 2018. I think that 2022 is going to be a fantastic year for commercial real estate. I really believe that, and quite frankly, my job hinges on it. We're a brokerage company. We want there to be more transactions. That's good. However, the debate is, will there be more transactions in 2022 than in 2021? And I have to remind you, there were a lot of unique tailwinds last year. In 2020, a lot of transactions were delayed. They got pushed into 2021. So we cannibalized some of our sales, moved them into 2021. That added to the total. There were record low interest rates. There was a lot of capital in the marketplace. We had $5 trillion of stimulus out there floating around, pursuing investments and yield. That spiked the market. There was a little bit extra adrenaline out there. And we also had very strong fundamentals outlooks for most commercial real estate types because we were coming out of a recession, because we were creating so many jobs. So we had these tailwinds that were very unique in 2021 that supported activity levels. Now, I'm not saying 2022 is going to be a disaster, or this is going to be terrible, but I do want to point out there are things that can happen in 2022 that will slow down the activity. I came up with 10. All right, number one, the number 10 reason is precisely what Hunter pointed out. Prices are going up, cap rates are going down. It's becoming very expensive to invest in commercial real estate. The numbers are getting harder and harder to pencil. That might slow down activity a little bit.
John, I'm so sorry. We hit the 2 minutes. I'm going to be strict about it. I would love to hear the other 9 points.
Oh, he ran over 2 minutes.
I know. He gets it. He gets it. Yeah, I want to hear the other 9 points during our debate.
Oh, okay, fine.
Thank you, John.
All right.
All right. Next up, 2 minutes on the clock. We are going to have Mr. Bob Fraser. You have until 41 and a half minutes on the clock. Sorry, John. I appreciate you.
Oh, sure.
We'll give him time.
It's good to be here, I think, as the token old person. So, yay for old people. It actually matters because I'm probably one of the few people in this room who lived through high inflation. And so, anybody remember the 80s? Anybody was an investor in the 80s? So I actually was. And so inflation, and I'll argue that our argument is not that there'll be more transactions, but that the transactions that do happen will be more profitable. And so inflation is actually a money-making opportunity. I've heard people say that inflation is neutral for real estate. It's actually very, very bullish for real estate. And there's a couple reasons for that, because it actually, NOIs, if your NOIs go up, track with inflation, of course, divide by the cap rate, the value of the property goes up, proportional to inflation, but it actually benefits equity investors in an outsized way, because the debt is the other way to make money. So what people don't realize, yet our government, in fact, does realize, that if you put $1 million in the bank, and after 10 years at 7.5% interest, that $1 million is actually worth $500,000 in buying power. So one of the ways to get rich in today's environment is to borrow money at fixed rates. And so as an equity investor, you both get the upside of the property and the debt that basically is paid for you by inflation. And so it's actually a perfect storm for, in a good way, a good storm, to actually make money in investment. Add to the fact the structural challenges that Hunter mentioned, not only in just because of COVID, but what's happened is since 2015, since the great financial crisis, there have been several sectors of the real estate market that have been massively underdeveloped. Single family real estate, basically very little new construction for 15 years, industrial, the same thing. And so we're paying the price now. All of a sudden, demand hits highs. It meets structural shortages that
Bob,
are not going
sorry.
away
Hit your
past
2-minute time
COVID.
frame.
I was
gonna
done.
catch up. Oh, okay. All right.
I was done.
Appreciate you. Appreciate you. Thank you. Thank you, Bob. Thank you, Bob Fraser. All right, 2 minutes on the clock. Kathy, you have until 38 minutes and 50 seconds. Opening remarks from Kathy Fettke.
Hey, hello. 2021 was a great year. Congratulations to all of you who profited immensely from that. Give yourselves a hand. So will 2022 be even better? Do you do the same thing? What do you do? The answer to that question is really going to make all the difference, right, on your strategy. I can tell you for sure the tides are changing. That's what I'll be talking about tomorrow at this time. The one thing I pay the most attention to when making decisions is what the Federal Reserve is going to do. The Federal Reserve controls the economy and manipulates it. So we really have to pay attention. And the boom that we just experienced, we can talk about all the reasons that boom happened. Demographics, migration patterns, but it really boils down to one thing, and it's called money, and lots of it. $6 trillion of stimulus, maybe more. We don't even know. We want to audit the Fed. We don't know how much it is. But what we do know is the M2, the money supply, the money that's circulating today, it was at 15 trillion before the pandemic. 2 years later, now, it's at 21 trillion. So that means that there's $6 trillion floating around, more than there was 2 years ago. So we better hope there would be a boom from that, right? That was the whole point. But here we are, it may have overcorrected. The Fed may have gone too far, because what we're seeing is more jobs than people want. We're seeing real estate prices booming, the stock market booming, and of course inflation. So what is the Fed doing now? Reversing. And this is the only thing I want to leave you with, that the Federal Reserve, the largest banking system that controls where the economy is headed, is trying to slow it down and is intending to slow it down this year. And doing that through rate hikes. That's how they do it. Will it be 3? Will it be 5? Will it be 7? No one knows. Investors don't like uncertainty. So they want to know where this is going to land. What we've seen is that the Fed sometimes doesn't stop in time. So often in the past, when there were rate hikes, it would slow too quickly and turn into a recession, or in this case, stimulate so much that we create runaway inflation. So,
Okay, Kathy, I'm going to have to cut you off. I gave you an extra 30 seconds because I felt bad about John. But thank you so much for your opening remarks.
thank you. All right. Be careful out there.
All right, production team, I'm going to ask them to help me move this back one more time. And while we're doing that, I'm going to, the reason Hunter got an extra minute was we were tabulating the results from the first poll. So the undecided folks, we got a lot of responses. Thank you for your participation. 16.5% of you are undecided, which means there is a heck of a lot of you that are pretty darn sure what's going to happen at this debate. 83.5% of you had a strong answer. 60.4% of you believed Heck yes, this is gonna be the biggest buy year this economic cycle. Well, good for you and your confidence. I appreciate having that here in the room. 23.1% of you said, it's not happening. We've had too many good years. This can't be the biggest buy year. So 60.4%, that's what you're starting with, fellas. Hunter and Bob are for the motion. 23.1% are against the motion with Kathy and John, and there's only 16% of the folks in the room to swing their votes, guys. Of course, you can say the exact opposite of what you answered in the first poll. It's okay. Nobody's going to know. We won't judge you. All right. I want to start off with some of the things that you guys said. Specifically, your statement, John. You kind of brought up a semantics argument. Hey, yeah, it's going to be a big buy year. That's not in debate. But is it going to be the biggest buy year? So, Bob or Hunter, I would love to hear your response to that. Is it going to be the biggest buy year?
I'll respond to that. We have yet to see the lockdowns really lifted. We have $6 trillion in excess savings that has yet to be spent. We have yet to see all the money printing that Kathy Fettke talked about actually translated into GDP. It's pretty much sitting there. It has not yet been. It's like logs have been put on the bonfire, but they haven't yet had time to catch because of the restrictions and other things. So we're seeing, I think we're going to see all that happen in this year.
Okay, well, he invoked your name, Kathy, so I'd like to give you an opportunity to respond.
Well, thank you. It has. The money's been circulating, and I think this year, as investors are seeing that rates will go up at a time when already asset values are so high, there's going to be a lot of that money is going to wait until those asset values potentially come down a bit.
Okay.
Can I add something?
You don't have to ask me permission.
Okay.
You know how this works. Get fiery.
Okay, so our position is not that the amount of transactions will actually increase from 2021. That's be very difficult just given the number of product and the amount of transactions that took place in 2021. It may happen, but when I talk about the biggest buy year of the economic cycle, it's kind of the intersection of prices and my confidence. We now know with a high degree of certainty that the Fed is unwilling to accept recessions, and they're going to go the route that Japan went and the route that Europe went. And when that continues to happen, more and more people are going to get wind of what we understand. And the prices are going to go down, up and up and up, and cap rates are going to continue to compress. So we understand that the transaction volume hit all-time highs, and we kind of seed that point. But the opportunity is that on a risk-adjusted basis, now is the time. Like, the lockdowns are likely over, COVID is likely over, and we've seen the difference between Omni, et cetera. The opportunity is now to purchase high-quality assets in undersupplied markets.
So I just want to clarify. John's making the argument that we can't have more transaction volume than last year. It's just not mathematically possible with some of the Fed money coming back. But you're saying it's not about the transaction volume that makes it the biggest. It's about the potential returns on your purchases that make it the biggest. Is that the argument?
Yes, I would say that the returns will likely be higher for assets you purchased in 2021 for obvious reasons. However, on a risk-adjusted basis, the biggest opportunity is right now. As in, if you had me on the stage in 2021, I said the same thing.
All right, fair enough. John, you had 9 other points you can get.
Oh, yeah.
Anything to
Well,
respond to that?
I got lots. Now, mind you, I want it to be the best ever. Now we're talking about risk-adjusted returns. Okay, fine. What could possibly go wrong in 2022, right? We could have changes in tax policy. We don't know. We could have rate increases. We could have geopolitical issues as we're facing here with Ukraine. We have potential changes in policies like rent control. They're arguing for that in Boston right now. We've seen it in St. Paul already. There is a lack of inventory. I asked how many people want to buy something this year to this room this morning. Everybody raised their hands. I said, how many want to sell? About 1 in 3. There is a shortage of inventory. Normally, Marcus & Millichap has an inventory of readily available listings between 3,500 and 4,000 properties any given day. Right now, our inventory is running about 20 to 25% below that because it sells too fast. Finally, there's other issues. We all took a vaccine. We don't know what's in it. It could be a zombie apocalypse. We could have a vaccine-resistant COVID. Joe Fairless is out there trying to buy everything anyway, so who knows if there's anything left. And of course, there are black swan events that even I can't figure out.
So why, again, is there 2,200 transactions available? Because they're selling too fast?
What I said was we normally have an inventory of listings.
Okay.
We're always listing property. We have between 3,500 to 4,000 listings active every day in our inventory for sale. Right now it's running about 20% below that because they're selling faster than we can bring them to market. And that's going to curtail the activity at this level because there's simply a shortage of inventory to buy.
So how does that end? Where's the change? Because I don't see enough inventory come in the market to detract from the incredible appreciation that's taking place.
Yeah, you can argue that's going to simply create price demand, right? And prices accelerating.
That's kind of our point.
Right, you're arguing yield and returns, and I'm arguing transactions.
So we both win.
Right.
First time ever. No ties. Everybody's a winner. All right. Well, I appreciate that point that's been made on both sides. I want to go to the affordability problem that this team mentioned, the Ford team mentioned. And Kathy, I want to go to you because you sell thousands of homes a year to investors from all around the country, secondary markets. What's your response to the argument that was made about the affordability problem? And if you would like them to reiterate it, we can ask them to reiterate it.
From an investor perspective?
This will be the biggest buy year motion perspective. I mean, if there's, what was the argument made on affordability? Let's just reiterate it for the room.
There's no way to solve the affordability problem, so it's going to get less and less affordable. We just don't see a way around that, unfortunately. But we're going to play the game the way that the rich get richer and the poor get poorer. I'm not going to be on the losing side of that argument. That's what I'm here to say.
And is the thesis that that's going to increase values such that the transaction volume by raw dollar count is going to increase because of the lack of affordability?
Absolutely.
Your response against team?
Just we're seeing wage growth already. There's such a labor shortage that employers are forced to increase wages to hopefully keep up with the costs. Of course, it's way off.
Okay.
But that is one. And having had interest rates so low for so long, it was still kind of working. But as they're rising, it's going to slow things down.
John, is that
That's the
look
intention.
saying that you've got something to jump in?
Well, I've been on the record this morning and said there's a massive housing shortage. I mean, I was right in, slide 8. And so there is a housing shortage. That is going to drive up costs. Affordability is going down. We're all going to be facing that. That's not the debate, right? In my opinion, we were asked, will we have more transactions this year? And the answer is probably not. Now, are returns going to be great for those investors who are buying commercial real estate? I'm the biggest cheerleader out there. I think that you can't miss, right? Well, you can, but it takes effort. But there is an opportunity here in housing specifically that is rare, and yields are great. The returns over the long term, when you're underwriting deals out 3, 4, 5 years, when you look out on the horizon, things are really strong. But there are going to be less transactions.
Fair enough. Can I make a counterpoint to my point?
Stop asking me permission.
Okay.
Let's go for it, Hunter.
Okay, so something that comes up a lot is the challenge with affordability being a reason why this can't continue. You can't possibly continue to raise rates if the consumer is being squeezed. But can you kind of give us your thoughts on the state of the consumer and this situation?
Yeah, so if you look what happened, we're in a historic time. We have never seen the consumer as healthy as they are today, ever in history. We've seen the household net worth increased 20% since 2000. The net income per capita, 15% per household since 2000. We're seeing debt service as a percentage of disposable income at a 40-year low. And including, in spite of the housing price increases, affordability is actually high due to the high income and the low interest rates. So I have several affordability graphs that showed this. So I think there's room to run, and the bidding actually shows that. So we're seeing consumers in absolutely incredible shape right now, and with pots full of cash.
So,
Can I jump in
please,
on that?
yes,
okay.
yeah.
Because I agree, we're in the single family industry, and I'm 100% housing is a problem and prices are probably going to go up. There's so much demand. But today we're talking about commercial real estate. So we're looking at businesses, they're struggling. Material costs have gone up, labor costs have gone up. So if we're talking about the tenant being a business, they're more challenged. I don't know if their balance sheets are as great as the consumer. That's why we're in single family, honestly. But that businesses, and now add to it higher interest rates.
Well, you also have what Bob said is true, right? Overall, you take the average, look at the numbers, there's a huge lift. However, it has not been equally distributed, right? So at the onset of the pandemic, the white collar, the business professionals picked up their laptops, they went home, they sat down and they started working. The service industry, those in retail, those in restaurants, those in the hotels, the frontline service workers, they were out of work. They lost a lot of ground over that time, and they're still trying to recover. So there is a portion of the economy, the portion of people out there who are doing very well, actually doing fantastic. And then there is a portion that is still trying to dig out of a hole that was created, and that segment is where you're going to see the pain, right? Those are the ones who are being priced out of the market. They're seeing the rent increases, and they're having a hard time covering that. That is going to be an issue. That's going to be a genuine issue as we go forward.
All real estate is not equal, that's for sure. There's going to be outsized winners, just like we saw 50% gains in industrial, and very great gains in some sectors and not in others. But let me address, this thing that Kathy brought up about, the party's over. The Fed is about to take the punch bowl away. And I want to point out something here. We have 7.5% inflation on a CPI basis. Right now, interest rates on the 10-year is 2%. So it means if I go buy a 10-year bond, I'm earning 2% per year, but I'm losing 7.5% in purchasing power. So my net is negative 5.5%. So if I buy a bond, it's literally lighting a match to my bank account, right? Okay, so what happens is smart investors are looking for inflation-protected real estate. Just like you look for high growth in tech stocks, you look for high growth in anything. And in today's day and age, high growth means pricing power and inflation protection. And let me say this about Jerome Powell. I think he's a good guy, but he is not Paul Volcker, okay? And Joe Biden, bless his heart, is not Ronald Reagan. Okay, so we are not seeing, even if he raises rates, he inches those little rates up to 3%. We still have negative real interest rates, burning a hole in investors' pockets. And as long as there is negative real rates, you will see real estate accelerate.
So what's the punchline that I heard that you give at IREC, which is Hunter Thompson's conference, by the way? It's excellent.
Hey.
Yep. So I heard a punchline that you said, a quote, a soundbite that.
This is the time. The way to make money is to borrow money and buy shit.
Borrow money and buy shit?
That's it.
All right, borrow money and buy shit.
That's our number one strategy.
Yeah, we're gonna put that on next year's best ever brand as a sign. Best ever, 2023, come check us out. Borrow money, buy shit. All right.
It needs a subtitle, at fixed interest rates.
Okay, all right.
Yeah.
But are there gonna be the sellers? I mean, both of you guys know about the sellers. Are there gonna be the sellers to match the demand?
Kathy, you want to start out?
I mean, we're both in agreement that this is going to be a great year. It's just not going to be as robust as last year. So still a great time to invest, but you just need to be aware that the tides are changing. If you surf, you just have to know, is it an incoming tide or an outgoing tide? And you still go out, but you just have to know what you're dealing with.
So let me actually break this down a little bit. Let me clarify the question, because I'm curious if we commit this conversation to just this room, the syndicators, the mid-market folks, and we take the KKRs and the Brookfields and the Blackstones out of the situation, they're buying tens of thousands of homes. Are there enough homes left over for your California investors to buy? Are there enough properties for the mid-market $1 to $10 million transactions or $10 to $100 million transactions for others to buy? Or are they being picked off by the top 20 ownership groups around the country?
I can speak about the single-family side.
That'd be great.
There's a lot of companies want to get headline news, so they come out with reports that aren't necessarily accurate. The investor share is 24%. It was 29% in 2012. So it's nothing new. Investors are always buying. Our group has been helping investors buy for 20 years. So it's normal what's happening now. It may feel like it when you're out there trying to acquire property because there's not much out there. But again, that's a single family. But I'd love to hear what you think about on the commercial side.
Okay, so I was just at a major conference about a month ago. I met with 35 different clients at that event. Everyone who walked into that room, it was a multifamily conference, everybody, I swear to God, everybody walked into the room to meet with me, said, we have $100 million to place into multifamily, we need inventory. Can you help us? And one person said, wait, we don't have
I don't know how that's bearish.
We don't have $100 million. We have $1 billion to place this year, right? And if I look around the room, all of the investors here, I'll ask every one of you, do you want to sell? The first thing that goes into the investors' minds when I talk to them is, I would love to sell. I want to take some of these chips off the table, but what am I going to buy? There's nothing to buy. I can't get any yield. I can't turn this into something else. I'm going to be left with cash and a disbursement, but I can't convert it into something else. That's the challenge. That's what the bottleneck is, the lack of inventory. So I want to get everybody in this room to sell their property this year so that Hunter can be right.
Heard it here
I'll
first.
take it. So one piece, it sounds like we're actually very closer aligned than I originally anticipated, which is good to hear. And it sounds like the audience is much more bullish than I anticipated, which is amazing. There is a lot of conversations about interest rates that I want to address. So first of all, Kathy mentioned that there's $6 trillion recently pumped. I think 40% of all the dollars that have ever been created were created in the last 24 months or something close to that. I accept the $6 trillion figure. But I'm going to add in a really important additional $4 trillion of global stimulus that took place. And the point here is that as the economy continues to be globalized, this massive slush fund, multi-trillion-dollar black box of how are we going to get yield in this environment is looking at one country, the United States, which is by far the most favorable risk-adjusted returns on the planet, meaning that it's not just us trying to place everybody that he knows has $100 million. It's not just us going to these conferences where everyone's having that conversations. It's a global phenomenon. And you have two tsunamis. You have a $10 trillion tsunami that a lot of it's going to try to go into the bond market and eventually realize they're burning money and try to go into real estate because of that, and the United States will capture a lot of it. And you have potentially another $1 trillion of significant accredited investor knowledge when it comes to this space. You've done a good job with this conference, but there's some massive tailwinds that you've been the benefactor of, which are people are starting to figure this out. And once the cat is out of the bag, much like the money printing cat, people don't go back. So as new millennials start to become accredited investors, we are very well positioned to accept both the tsunami of tidal wave of interest from accredited investors as well as global economic policy.
All right, response.
That's a great point.
That was a great point.
Actually, I'd argue there's actually even more money than what you're citing, right? Because there's $6 trillion in savings in excess of normal that's coming out at some point. And on top of that, we're seeing a change in the allocation by institutions moving money from traditional investments, stocks and bonds, into commercial real estate. There is more and more money coming into the sector every year. But in terms of the actual number of transactions that'll take place, that is where you're going to bottleneck. And that's where your prices go up. That's where your cap rates continue to compress. I think Hunter pointed out, cap rates, in many foreign countries are actually well below what they are here in the United States. That's a higher yield in the US. That's all working to the advantage. There is room for cap rates to continue to compress, but they are meeting rising interest rates. If a cap rate is at 3% and your cost of capital is 4%, it makes it really, really hard to convince people to invest into your negative yield scenario. That's where we're going to hit a problem.
I agree. Sorry, just on interest rates, because I missed my point real quick. So that $1 trillion thing is looking for yield. The United States bonds are extremely compelling compared to negative interest rate bearing every industrialized country bonds, European bonds, Japan bonds, German bonds. They're all looking for yield. And for some reason, which I truly don't know the answer to, United States bonds have positive rates. So I anticipate this conversation about when are rates going to go back to normal being when are rates going to go negative. And I'm 100% confident that they will. It's over an infinite time period. I don't know when exactly, but to his point, they already are on a real basis.
In Europe, the nominal rates are negative. But here's a missing point, and I find in all the analysis that I've read out of Marcus Millichap and out of CBRE and everybody else is missing one key element. and that is the relationship of cap rates to real interest rates. They're all tracking to nominal rates, but in fact, cap rates historically are tied to real rates, meaning the yields less inflation. And so if, and during the 1980s, for example, the high interest 1980s, okay, you saw cap rates actually drop and go down in that period. And so I want to see research coming out of these guys that look at nominal rates. Look at real rates. We've actually lost the ability to do inflation kind of metrics and calculations and analysis. It seems like since we've hit the 2% regime over the last few decades, all the people that understood inflation have disappeared from the planet. We need to call the 60-year-olds out of retirement and get them to give us some insight on cap rates and real interest rates.
Well, it has been 40 years. Is that
You're talking about inflation-adjusted yields, right?
Yes.
And absolutely, your cost of capital is affected by the same inflation, and your yield is affected by the same inflation. So you're just taking the whole thing, you're just moving it up or down by the same number. So it's the spread doesn't change once you do the inflation adjusting. So they are what they are. And if it's
the
still
relative
inversion,
trend of the spread is what you're
exactly.
saying. Okay.
It doesn't vary too much. It's still, if the interest rates are going up and the yields are compressing, they will cross over, and you can do that on an inflation-adjusted basis or a nominal basis. It doesn't really matter.
So I want to put a ding, ding, ding on this. And before we move on to phase 3 of our debate, I want to ask one question a bit unrelated. Should everybody just sell?
Jeez.
To me.
No.
Right? No. The thing is that there are times to sell, right? What is your return on equity, right? If you have a big pile of equity stored up in a property and you are not selling it, okay, my dad does this. He's like, no, I like this. It's all paid off. It's great. I'm like, Dad, your return on equity is terrible. He's like, it's okay. I don't have to worry about it. But the fact is that by selling those assets where he's paid them all the way off and then reinvesting them at today's yields and today's rates, he'd make more money. But he's overly cautious. So there are people who should be selling. There's times to take some chips off the table. You want to look at things like changes in capital gains taxes. We almost had a rate increase. If you were anywhere near time to sell something off, you could get a 20% capital gains tax, or they were threatening 40% capital gains tax. That's a big difference. So you kind of have to look at the dynamics. Is there anything causing you to say, hey, we should all go sell right now? No, not unless you have a specific reason or a specific strategy that you're working toward. Am I selling out of this property? Am I selling apartments because they're selling at a premium? I can get a 3 cap, and I'm going to move it into retail where I can get a 6 cap, and I can convert that and make a higher return. There is a strong argument for that.
So just to be clear, your role for Marcus and Millichap is to generate transactions, yet you are here claiming, pump the brakes if it doesn't make sense for your
My
family.
role at Marcus Millichap is to help investors create and preserve wealth through the best research and advisory services. That is my mandate, and it is written into our mission statement.
Amazing.
My job is
I
to
love
help
that.
you.
Marcus
And
and
they're good at
Millichap for the values win. All right, simply put.
I'll say this. Let me answer that question as well.
Sure.
So if inflation heals all wounds, I mean, if your NOI, if your NOI tracks inflation, if you can raise your rents, if you have pricing power, and you have fixed rate debt, then just wait. You are going to mint money as long as inflation is more than nothing, and it's going to pay off your debt. So absolutely not.
So even if you've experienced massive appreciation the last 2-3 years, you've pushed NOI, your debt to asset ratio is 30% just because of how much you've pushed the value of your business. It's still just not the right time to sell. Wait another year or two. Inflation will push it even further.
If you have pricing power and if you have good terms on your debt, absolutely not.
I mean, it depends. A lot of our investors at Real Wealth are selling in more high-priced markets and markets where they're not very investor-friendly at all, and even more so now that things are getting worse. So we're seeing a lot of people wanting to sell out of those markets and get into more friendly, investor-friendly markets where the cash flow is better. So that's why we're seeing such growth in the Southeast and other areas. So like you said, just changing up the asset, and also there were a lot of people concerned, and this may have been part of the craziness of last year, that taxes would go up with Biden, and they were in a hurry to do all of that before that happened with the capital gains, possibly going up to, what was it, 39% or something like that. So there's a theory that that's why people were moving quickly last year.
Okay, Hunter, final word on the subject.
Let me jump in real quick.
Okay, all right.
I
30 seconds, John.
I had a meeting with a client. They had all of their assets, multifamily, in the LA area. They were going through and doing a retrofit for earthquakes so that the buildings don't fall down. And the owner sat down and he said, you know what? There's a reason we have to do this, because we might have a massive earthquake. All of my equity is in one general area that could get wiped out in one earthquake. That's a bad strategy. He came to me, we sat down, we repositioned half of his portfolio into markets across the United States. He sold off half his assets in LA. That makes sense. That's a strategy that you want to consider, is the diversification of your portfolio.
Okay, option for a final word on the subject before we move to phase 3 of the debate.
Yeah, I think another question, if I could, would be, should you buy everything? Right? No one here really wants to sell everything. So the question is really, should you buy everything? And I would say no, but with the right sponsors in the right markets, with that supply and demand disequilibrium, absolutely. Like, if I were to rename this debate, it would be, is this a back the truck up moment? And it is a back the truck up moment for those who know what they're doing. And if you don't know what you're doing, strategically partner with someone who does and solve that problem. Because anything that's sitting in a bank account is getting smirked right now, and it's not by 7.5%. If you follow shadow stats, for example, probably closer to 15 to 20%. And you don't want to do that. There you go.
Great segue back to our main motion. So we're going to move to phase 3 of the event. We're debating whether or not 2022 is the biggest buy year this economic cycle compared to every year since the GFC. Debating for the motion has been Bob Fraser and Hunter Thompson, and debating against the motion has been John Chang and Kathy Fettke. Phase 3 is going to be 2 minutes for closing arguments. Kathy, you would be up first. Are you ready?
I'm ready.
All right, 2 minutes on the clock. You have until 8:40 on the clock.
Okay.
All right?
I just want to say that the last 2 years were crazy and weird, and a lot of the numbers were skewed and really fantastic, right? We're seeing wild numbers. But when I sat with John and was going through the charts, I thought, okay, GDP had huge growth last year, but the year before it was negative. So when you balance it out, we're kind of where we would have been if this pandemic never happened. We had 22 million jobs disappear 2 years ago. 85% of them are recovered. That's amazing, but that's 85% of what it was. So when we say we have a booming economy, we're really looking at a situation where we went so negative and we're bouncing back to kind of where we were. And in that, all of that happening, we have low inventory and rates going up, and a Fed that wants to slow things down. We're really kind of where we were 2 years ago, with higher prices though. So that's why I do believe that it's going to be good. It's going to be a good year for sales. There's no other better place to put your money than U.S. real estate, in my opinion. But it'll be lots of transactions for all of us, but just a bit less than last year.
Thank you, Kathy. I'm going to give the extra 40 seconds you saved to John later on.
course.
Okay, closing arguments, 2 minutes. Mr. Bob Fraser, debating for the motion.
All right. Well, I made the point, but I'll make it again, that cap rates follow real interest rates. They track real interest rates. Real interest rates right now are massively negative, and even if the Fed raises rates, they are not likely to raise them very high, especially given the political climate. Let's add the political climate. Okay, you've got the midterm elections coming up. Do you really think a Democrat-controlled Federal Reserve is going to be excited about raising interest rates in the face of an election, or follow a couple years later the presidential election? They're going to be kid gloves on anything. Furthermore, even with Ukraine happening, the Fed has shown in the past reticence to put the brakes on when there's geopolitical crises. So all that means that we're unlikely to have a Volcker moment, where he just literally slams the brakes on and says, party's over, stock market crashes, real estate prices crash. It's not going to happen. It's very unlikely to happen. And even if they do, the research I've done shows that when the Fed raises rates, there's a 6 to 18 month delay before it actually impacts the market in a significant way. There's so much juice in the market. You've got, like I said, the consumer that is in incredibly good shape. They've had cabin fever for 2 years now. They've not been able to get out and go travel, spend the money, buy shit, and they're going to do it. And they're getting ready to do it. There's $6 trillion in savings sitting there. And anybody that says there's going to be a recession in the next 2 years, they're going to be proven massively wrong and embarrassed. We're going to see massively high GDP growth. We're already seeing high GDP growth. As soon as the velocity of money recovers and we're seeing the money printing be turned into GDP, we're going to see that happen.
Brass statements. If you're predicting there's going to be a recession in the next 2 years, Bob is going to embarrass the heck out of you. All right, 2 minutes and 30 seconds for John Chang until we hit down to the 5 o'clock on the time.
Okay, so is this the biggest buy year ever? Okay, now we've broken that into two different things. One is our position, which was there were 84,000 transactions last year. That's going to be a tough number to beat. We don't think we'll surpass that on a number of transactions standpoint. And the other side that was argued was it somehow got turned into a conversation about yields. Is this a good year to buy? And yes, it's a good year. And actually, I would argue, is it the best year ever to buy? No. Look back, 2010. That was a great year to buy.
But we can't buy in 2010 right now.
No. Hey,
That's my fault.
shut up. That's not
It's his closing arguments.
The other one was back in 2020. And when we had a shutdown of the market, there was a COVID, there was a pandemic, that was a great year to buy. We're in a good year. It's going to be a very good year. I don't think 2021, those who get in 22 are going to probably be on the cusp of whether or not they can beat the yields on 2021. So I don't even know, even when you steer the conversation away from the actual transaction count, which was our interpretation of it, and you get into the yield, I don't know that you can actually get to what Hunter and Bob are arguing. So
And then remember, my last comment, I have to add it in. There's one thing none of you have mentioned. And
2 minutes,
what?
They have 40 more seconds. They have 40 more seconds.
The U.S. Pluto return was on 2/20/2022. And the last time that happened in the U.S. was on July 4th of 1776. And it falls in the financial sector of the U.S., which is death and rebirth. You didn't even talk about that.
The Pluto return. Apparently, the debate was not.
U.S. Pluto return.
For semantic purposes, in my moderator role, 2010 is part of this economic cycle. I just want to be clear. 20 more seconds. Anything else to add?
No,
Okay.
Go ahead. Well, I'll give it to Hunter. He'll need
All right, Hunter. Final thoughts. Debating for the motion. 2 minutes on the clock until we hit 3:15.
Real quick, just got to give a shout out. Both of these people are so impressive. Like, it's such an honor to be up here with them, and also my partner over here. You guys don't watch her show. Like, she is an OG of the podcast space, and the reports that they put out at Marcus and Millichap are excellent. They have made my case very strong, but they are very excellent. I want to just take a quick second. Like, what he just said is actually a really important part of my argument. If they say, hey, it's not a big buy year, because look back to 2010. That's exactly the case I'm not making. What I'm saying is look forward and see how this is going to play out. Everybody in here wishes they bought more in 2014. And that's how you're going to feel in 2022 if you don't do what we're advocating. Everything you can to buy quality assets in underserved markets. If you don't believe me, good. I'm going to try to do it anyway because that's fine with me. But that's why you guys come here. And lastly, this is a really important point. He brought up the risk of the zombie apocalypse through vaccine stuff. I'll cede that point.
All right, and that concludes year 6 of the intellectual debate at the Best Ever Conference. Thank you, John Chang. Thank you, Kathy Fettke. Thank you, Hunter Thompson. And thank you, Bob Fraser.